The Footprint course, Unit 13, Breakout Trading. This is challenge day 24 of 30. In the following slide, we are going to focus on the harsh realities of trading in the financial markets, as well as some of the fundamental truths you need to learn and adopt.
The crux of it is, what color is the apple? And I'd like you to all just take a second now and think about it. What color is the apple that you can see on the screen? Take a while, think about it, and write down what you think the color is. Okay. Now, I'm pretty sure all of you, or most of you, have come to this conclusion that the apple is red. Okay? I think any logical, sane person would agree that this is a red apple. But what if I told you that, actually, I don't think this apple's red, I think it's yellow? What if I told you it was a pigmented apple? What if I told you it was a white spotted red apple? The crux of the matter, guys, is that what we are taught when we're young, what we are taught as we grow up, we hold on to that, we fixate onto that, and we are not willing to let go of that. In other words, I bet you, if most of you are standing in front of me now, you'd say, well, that's a stupid argument. Well, what's the point of that? Well, that is the entire point, is that you are not willing to look through the fact that actually this apple might not be red. Actually, it might not be red. Think about that. Put yourself in a different spot. What happens if this apple isn't red? What happens if this apple is truly yellow? And that's the crux of what tonight's about, guys. What I want you to understand is the markets don't reward the obvious. They don't reward. If you told me that apple's red, I'm going to say, well, brilliant, it's obvious. Everyone knows that. Okay? If the markets were rewarding the obvious, everyone would succeed. We wouldn't have such a high failure rate in trading. Right? The markets reward those who understand the rules and apply themselves according to those rules. Okay? Stop looking at the markets as wrong or right and start looking at them from a perspective of what made this market rally. In other words, if you came in, what the typical trader does is they come in on a morning, they have this preconceived idea, they've got a candle, they've got a setup, they've got a technical indicator, and they come in and they say, I want to buy this market. Why? Because, well, my predisposed opinion is that because of X amount of factors, this apple is red. This market is going to go down. Okay? And all of a sudden, when you enforce that into your belief system, guess what? Yes, it might work. Okay? But time and time again, it's not going to work. Why? Because when it is that obvious, it's not just obvious for you, it's obvious for almost every single other participant in the market. So stop looking at the apple as being red. Start looking at the apple as being yellow. Alright? So when you look at the markets, say to yourself, what made this market rally today? Not, I knew it would rally, but what made it rally? What were the key facts that told me or that hinted to me that rally was on? Was there high volume? Was there volatility? Was there a breakout of a triple top on a key level that we've held for the last 12 months? What was it that gave the clue the rally was on? In other words, what fact can I draw down from the market that made it ultimately rally? Why was it aggressive there? Why was it passive at this point? What made the market go sideways today? Why were there no stops when it took out this breakout point? Note, guys, when you start to look at the market from this objective approach, okay, just like you look at the apple from an objective fact base, which is there's red, there's yellow, there's white spots, there's all sorts of things going on there. When you look at it from an objective approach, guess what? You're going to start recognizing the patterns that exist within the market, the rules that your market trade by, and not the rules that you believe they trade by. You do that, you're on the right step for progress. don't forget, in this job in trading, you only need a couple of prices a day. You don't need to take a million ticks out of the day. Some of the most successful traders only take a few price increments every day. Okay, there are thousands of strategies, guys. You just need to draw up, just get a 1 minute chart, and you will see thousands upon thousands of strategies or movements within the market that you can learn to capitalize on. But you're going to have to get out of this ingrained belief that the markets are like a red apple, because they're not, and they never will be. Note, an apple is only red because you have been taught to identify it that way. Alright, stop being so delusional.
Hopefully that mentored session really provided you with some of the real truths about trading in the markets, and hopefully dispelled some of the maybe false truths that you might have had originally. Now, obviously, as we move into breakout trading now, this is the second of our context and footprint based strategies. This is very much a momentum strategy and very much an aggressive execution strategy. So just like every other strategy, we're focusing on a number of principles. Again, with the breakout strategy, there are some really unique principles we're going to focus on. The first being obviously initiative, identifying initiative and responsive price behavior. But then most importantly, how to identify those tops and bottoms, i.e. market context. So market context is vital to the breakout strategy. But then again, we're really going to focus all our attention on the interaction between the buyers and sellers around that break point. I'm going to introduce 5 fantastic signals or clues that the market sends you just before we get some really crucial breakouts in the market. Obviously, before we move on to the real breakout, I try and identify and highlight really the principles underlying a breakout. In other words, why does a breakout occur? What is required for a breakout to occur? Now, in order to understand that, we move ourselves back again into the concept of time frame participants. We focus crucially on the influential time frame participants and their role ultimately in the financial markets. Obviously, a couple of the other key components of this trade strategy session will be liquidity as well as again our color lines. Okay, good luck with the strategy session. Enjoy it. This is a fantastic trade strategy. It's going to show you some really good ways in which you can begin to execute your breakout strategies a lot more successfully. So into the strategy unit now of breakout trading. Now, I know a lot of you are probably very excited about this strategy session, simply because breakout trading is probably something most traders have at least experienced in some format. Now, my hope is obviously by not just the end of the strategy session, but by the end of the unit, you'll have a very objective, processed approach to executing your breakouts. Okay, the information I'm going to give you in the next couple of moments, you're going to begin to realize that breakout trading, whilst is seemingly obvious, it's actually filled with some really big pitfalls in which most traders fall into. Okay, now what I am going to say is that if you do follow the really process-based approach I'm going to show you, you can increase the probability of your success with breakouts tremendously. Okay, now before we move on to that, I just want to talk very briefly about this concept of right and wrong. Okay, unfortunately, in this day and age, we tend to think that things are either right or wrong. And unfortunately, we taught this from a young school age. When you write a test, you get given a tick or a cross. So everything in our lives is right or wrong. Trading's no different. If you do well, or you do seemingly well, you make profit. If you do seemingly badly, you make loss. Okay, now I really want you guys, if there's one thing I can get across in the strategy session, lose the idea of right and wrong. There's no such thing in trading. Okay, I've seen traders do what I feel is seemingly the wrong thing at the wrong time and make a lot of these things, make a lot of profit. Okay, I've seen traders do the right things at the right time and take a big loss. Okay, so there is no right or wrong in trading. If you can start off by believing in that principle, you're really on the right process to a growth mindset. Now, the reason I want you to get away from this idea of right and wrong is because when you start to think things as right or wrong, you naturally start to create a bias. Okay, and when you create a bias, you can no longer have a growth mindset. In other words, like I said to you, if I showed you obviously a red apple, okay, it doesn't matter how much I argue with you, it doesn't matter how much I try and prove it to you that it's not red, okay, you've got a bias. Okay, you know what red is, you're never going to believe my side. Doesn't matter how much objectivity I can show you, you're just not going to be willing to listen and learn. Okay, now that's obviously the first element I want to sort of mention. Now the second thing is, and it came out of the mentored session, was this concept of an exact approach. Okay, a lot of young traders, even a lot of developed traders, are really going in search of an exact approach. They almost want some form of a 100% if A equals B, then do C. Okay, now unfortunately guys, we are discretionary traders, we are not algorithmic traders. Okay, so by that very definition, if you want to develop an exact process, right, then you need to obviously look more towards an algorithmic type of approach. More importantly, remember, if you do go that way, the rules change again. Okay, there's certain rules governing algorithmic trading, there's certain rules governing discretionary trading, there's certain rules governing hedge funds, okay, there's certain rules governing institutional trading, right? Those rules differ depending on what in which element of the market you find yourself. Now, note the last thing I want to sort of just mention, and this is something I've learned throughout my career, and you're going to learn this through the books that I share with you. The reason I recommend these books, okay, is not because I think they're going to teach you to become great traders. Okay, I give them to you because I want them to provoke thought. Okay, now when your thoughts are provoked, one of two things is going to happen. Okay, you're either going to adopt the principle, in other words, you're going to believe in the principle, you're going to adopt it into your everyday life, and it'll become a part of you, or you're going to ignore the principle, okay, and you're going to move forward. Now, that's the purpose of every book. I want to provoke your thought, and I ultimately want you to adopt some principles that you find valid and ignore the rest. Okay, but the most important thing, and this is the key to thought-provoking principles, is that just because you adopt a principle does not make it yours. Okay, and this is the same in trading. We see there's so many successful strategies, so many successful trades. You know, I'm showing you guys 10 unique strategies here. Okay, now it's so important that you recognize the real truth, which is that I can only show you principles. Okay, I can only give you the principles. That's all I can give you. Yes, I can show you trade strategies that work well. Yes. Okay, but what you have to accept is that you cannot simply just try and adopt my principles and become successful. Okay? You have to adopt those principles, and then most important, apply yourself. Okay, because it's this self-application, right? That's where you go into the market. That's where you test out these principles. That's where you utilize the footprint in a number of examples, and you find a way, you find a strategy. That application, that's where the real money comes from, guys. That's where the real edge is developed. Okay, I'm not giving you an edge, yeah? I'm just showing you some principles and strategies. Okay, you're going to have to give yourself an edge through self-application. Okay, now note, obviously we are talking about breakout trading. Now, I just want to talk about the key elements to breakout trading. But before I do that, before we can understand breakout trading, let's understand, why do so many people fail? Okay, so all of you should be saying to yourself, well, yeah, okay, breakouts are pretty obvious. Okay, you just look at a chart, there's maybe a double bottom or a really key inside day, and therefore there should be a breakout. Okay, so we're all good at identifying it. But guess what? If you can see a chart, so can every other retail trader in the world, so can every other algorithm in the world, so can every other banker in the world. Everyone can see a breakout. Okay, so the first thing to note is that a breakout is obvious, public knowledge. Now, I hope straight away you're going, oh, okay, I didn't realize that. Because guess what? If a breakout is public, obvious knowledge, then it means that there's likely to be a lot of noise. Why? Because there's many participants. Okay, so that's the first thing to understand about breakout trades. It's very, very obvious. Now, the reason why most people tend to fail on breakout trades is very simple. Okay, most people don't understand the basic logic behind what creates a breakout trade. Okay, and because they don't know what creates the basic elements of a breakout trade, they don't know how to execute in terms of timing. Okay, so what ends up happening, if I draw a basic example, we have this really key resistance, great breakout level. Note, nice dark blue line because we've identified as key resistance. Okay, people get long, it goes up, tests, fails, comes back, they stop out. Maybe they buy it again on a little failed break, stops down, comes back. Maybe they buy one last time at the high, stops, starts to turn over, and they give up. Okay, they've taken the loss for the day, probably stopped out on the day. Eventually, later on in the afternoon, the market breaks. Okay, we get the breakout. Now, what most people do in this situation, they go and say, okay, it was a bad breakout. Yeah, it was a bad breakout. Didn't break there, and it wasn't a really good breakout level. Okay, and that's where the analysis ends. That's where the real honest, objective approach ends. Now, what the whole strategy-based templates teach you is that that's not good enough. You don't just go and say, okay, well, that didn't work. We look at all the various elements, every single element around this breakout, from time, relative changes, delta, all these things. We look at them and we break them down one by one by one, because that's where we pick up on the subtleties. Now, this is the reason why so many people end up failing, because they don't know how to time a breakout. Now, before we get on to me showing you the key principles of how to time a breakout, let's just discuss something else that's quite important and pertinent to breakouts. Okay, the first is the auction process. Right, in order to understand an auction process, or a breakout, sorry, you have to understand how an auction process works. Okay, so let's go back to it. Basic, elementary stuff. Sorry, I know I go through these things over and over again, but the whole point is so that you can understand the philosophies, the principles, so that you can ultimately become better at breakout trades. Okay, so the basic premise is that's a discount, and that's a premium. And ultimately what happens is the market will tend to find fair value within that price range until such a point that this fair value is no longer, that should say longer, valid. Okay? Now the moment, and only at that moment, that fair value is no longer valid, will initiative be taken in one direction or the other. And that's the key. That, if there's one thing you take away from that, a breakout. Okay, I'm going to write this. Oh, jeepers. Sorry, guys. Apologies for the spelling. Let's try that again. Okay. The breakout. Okay. It needs initiative. Okay. It needs someone to take initiative. Now, we've spoken about this principle a lot. How does someone take initiative? Well, does it come? We've spoken about the three, obviously, participants. So we've got the influential participants, we've got the algos, and we've got the speculators. Now, what you've got to say to yourself, who can create initiative? Well, it's not the speculative. Definitely not the speculative participants. They can try, they're going to fail. Not the algorithms. Okay? Why? Because, well, by nature, algorithms are very exact in their process. Okay, so, for instance, if they do try and go for the break and it starts to offer, they'll all be scaling out on the way down already. Okay, so the nature of algorithms means that they won't likely be able to hold initiative. So it's only one participant, which is the influential participant, that can create initiative. Now, until such a time that that influential participant steps in to initiate, to move the market into price discovery mode beyond fair value, you will not get a breakout. So I hope you understand that, because that's the premise of it. Now, what I'm going to show you in the next couple of slides is I'm going to talk all about this concept of timing. Okay, because this is the single most important principle when it comes to a breakout. Make a note of that. Now, the reason timing is so important is because we are going in search of the initiative or the influential participant. So if we know that the basic premise
of a breakout is all based on this chap. All we have to do is learn an observation, fact-based approach to identifying him. And I'm going to show you how that is. Now, before we move on to that, let's just talk about some of the other principles that do underline a breakout. So the first one, in order for a breakout to be successful, all participants, will be in agreement. In other words, in order for a breakout to be successful, we need obviously, number one, the initiative. Okay? But what we don't want is we don't want someone suddenly responding on the other side. Okay? So we don't want someone providing liquidity on the other side on a breakout. Okay? So we need all participants, all of them, influential, algorithmic, and speculative. We need them all in agreement. Okay? Now, the next thing is obviously, how do we determine now our key support and resistance? Okay, we're going to come back to the timing, but how do we determine key support and resistance? Now, we spoke about this quite a lot, over the last couple of units. We also did speak about this quite extensively in Unit 3. I'm not going to go over it in great detail, just very simply. Okay, we can identify a breakout by the break. Okay, and we said obviously the key elements of the break that we're looking for: time, volume, delta, volatility. Okay, so if we have all of those, high volume, quite an aggressive, in terms of time, quite an aggressive move, a delta within the direction of the break, as well as an increased pickup in volatility, those signal a really good break of resistance and support. Now, what we're interested in this entire strategy session is we want two trades here. One, we want to be able to position ourselves for the break. And two, we want to be able to add once we've got the break. Okay, and that's what this strategy session is about. It's about being able to execute twice on the single strategy of breakout trading. Now, some of the key support and resistance areas that you can look at. Now again, guys, I'm going to give you a couple of examples, but this is by no means an exhaustive list. Please understand that. This is not an exhaustive list. You have to go and learn through trial and error what makes good breakout highs and lows. Now, the first example is double tops and double bottoms. Okay. The second type is tail highs and lows, which we've spoken about. Tails, I'm just going to say tails. Then this third type is obviously key swing high and low within a trend. Very key. Okay, so what we mean by that is simply market comes up, maybe rejects a little bit, turns back over. Once it takes that out, it's a key swing. When we extend, you tend to get a breakout. Okay. Then our fourth one, inside days. Okay, so inside days. Okay, important with these inside days, right? We want to identify, is it consolidatory in nature? So was it consolidation or absorption and auctioning? Again, if you can differentiate between the two, you're going to know which is a better breakout than the other. Then obviously, where we have a trend day, the next day, so day 2 of trend, tends to provide very good breakout trades as well. So those are the 5 that I'm going to provide you with, but there are numerous other reasons why a market can ultimately break up or down. Okay, so that's for you to identify and learn through trial and error. Now, let's get to the real integral part of the breakout strategy. Okay, so with regards to timing, there's 5 elements that we're going to focus on. First is absorption. The second is delta. The third is relative change. And this relative change can come in terms of volume or price. I'm actually going to call that price variance. Volatility or velocity expansion. Okay, velocity is just the manner in which prices move. Okay, so if the prices are kind of moving like this, and suddenly it just goes like that, okay, that's velocity. Okay, so velocity expansion, and then obviously imbalances. Okay, so these are the 5 timing, we're going to call them timing clues. Okay, they're the clues. Okay, they tell us that ultimately something's changed. Okay, and potentially this influential participant stepped in. So absorption, I'm going to explain it to you with a breakout graphic. So if I can, I'm just going to use the left side of the board. Okay, so if we have our breakout, again, we're going to use resistance. Okay, so if we have our breakout, obviously, our first one, absorption. So the market might have formed a flag, which is quite typical before a break. So we get this flag, market starts to turn back over, and just at that high point, we start to see the buyers absorbing. So we see someone trying to sell it at that resistance, but the buyers are absorbing, okay, ahead of the break. Okay, this is one of the most consistent ones that you tend to see on breakouts. Okay, so the buyers absorbing ahead of the break. Now what that's going to look like in terms of the delta, potentially a lot of dark blue. Generally it will be a blue color in nature. Why? Because the buyers start to initiate and become aggressive. There's not likely to be much selling liquidity there. Okay, by the time the buyers do become more aggressive, they're actually going to lift through the breakout zone. Okay, so that's why we do tend to see buyer absorption rather than buyers being aggressive initially. Now, the second then is obviously the delta, as I mentioned there. Okay, you're going to suddenly see a shift in the colors. So what you'll typically see, if this is maybe the bar just before a break, you might have been seeing a whole bunch of light colors, and suddenly just before the break you get this really, really dark color. Okay, a nice dark blue or something. Again, a nice visual representation of the sudden shift that's coming from the initiative being taken by potential big participants. Now the third is obviously relative changes in either volume or price variance. So again, what you will see a lot of the time is within this maybe consolidation zone or even absorption and auctioning zone, you might not see a great deal going on. And all of a sudden, you'll see the volume sort of ticking across, maybe 1,000 lots every couple of minutes. And suddenly, just before the break, you suddenly see it move to 3,000 contracts. Okay, again, another very, very important clue that something has shifted. Okay, the game has changed, and we're about to respond in terms of price. All right, obviously, the price, again, this is another clue you're going to see. I will show you an example of this. But where price, the variance of price changes. So again, if we're used to seeing maybe, 5 tick rotations, 5 tick rotation, and then suddenly you get, a 12 tick rotation. All right, this is a real clue, again, that something has shifted. The initiative is now being taken. Okay, obviously that ties in with velocity in terms of expansion. So again, velocity isn't necessarily directional. Be careful, do note that. Just like volatility doesn't mean trend. Okay, it doesn't mean that because there's velocity or it doesn't mean because there's volatility or velocity that prices are going up or down. Okay, it just simply means that they're moving over a greater range. Okay. And then the last one is obviously an imbalance. So sometimes what we rarely see just before the break is some sort of an imbalance. Again, the imbalance you're more likely to see when the market isn't necessarily beginning the breakout at the extreme. It might be beginning the breakout here. Maybe the initiative starts, and within that initiative, we initially get some form of an imbalance. Okay, but the most important thing in this early example where the breakout begins early, right, this is obviously giving you a far better opportunity to execute for a much bigger winner in terms of a breakout. Why? Because it's showing you the signal, the timing clue, very early on. Okay, but you have to be aware of the 5 different types of timing clues, and there they are: absorption, delta, relative changes in volume or price variance, velocity in terms of price, and imbalances. Okay. Now let's go look at some practical examples. This is where we're going to really get a good feeling for this and understand this a little bit better. So the first example,